Welcome back to the Deep Dive. I'm John.
And I'm Wendy.
We're both staff here at WeWire, and we're here putting together your weekly Stay Wired recap for you.
That's right. And today, we're diving into something that might seem, well, a bit remote at first glance.
Yeah, but it can have a surprisingly direct hit. I mean, think about this, for instance. During the 2007-2009 financial crisis, 168 banks failed just in the United States.
168. Wow.
And that triggered these massive disruptions that just echoed right through global supply chains. We saw trade volumes drop significantly in regions that were exposed.
And that striking example, it really brings us straight to our core question for this deep dive. What actually happens when your supplier's bank fails, say, 7,000 kilometers away?
It sounds like someone else's problem, doesn't it?
It does, but as you just pointed out, it's a very real vulnerability in our, super interconnected world. These global trade networks, they're incredibly efficient, sure, but they're also surprisingly fragile when it comes to these distant shocks.
So what are we drawing on today?
Well, for this deep dive, we've pulled together insights from quite a range of authoritative sources. We're talking data from the IMF, the International Monetary Fund, the World Bank, lots of Bloomberg reports, and some detailed studies from places like the Quarterly Journal of Economics.
Okay.
And also financial platforms like Rapid Ratings. So our mission today is basically to explore these kind of hidden vulnerabilities, understand exactly how these financial shocks can amplify economic downturns.
Right.
And most importantly, equip you with some practical strategies, things you can actually use to build resilience into your business.
Okay, so let's pull back the curtain on this then. What actually happens the moment an overseas bank, goes belly up? What's the immediate trigger? How does it hit that supplier first?
Well, what kicks it off, often it's pretty straightforward. The bank simply can't meet its financial obligations anymore.
Oh.
Maybe there's a run on deposits, too many people pulling out money at once. Or maybe their investment suddenly tanked in value.
Right. Could be regulatory issues too.
Absolutely. Or perhaps regulators just weren't overseeing things properly. We saw some echoes of this in 2023, actually. It prompted the IMF to warn about, heightened stability risks, especially with central banks tightening things up, making money more expensive to borrow.
Mm-hmm.
So for your supplier, when their bank fails, it means their accounts instantly freeze. Poof.
Just like that.
Just like that. Their access to credit, it just vanishes. So suddenly they can't process payments. They can't secure the loans they need for just everyday operations. It's this abrupt, really devastating halt.
And what's fascinating, I guess, is how quickly that direct impact starts to cascade, right? It's not just about their bank account being frozen, is it?
No, exactly. It ripples out fast.
Oh, yeah.
So when your supplier can't get to their funds or they can't get new credit, they immediately can't fulfill your orders on time. And that leads directly to disrupted supply flows for you. There was a Bloomberg report that highlighted how these kinds of financial system issues can really crank up inflation pressure.
Really? How so?
Well, especially for smaller businesses. The ones that often provide really critical, maybe niche inputs into your product.
Yeah.
Imagine that small factory, maybe in a distant country. Suddenly they can't pay their employees. They can't buy raw materials. They can't service their debts, all because their bank failed. That's just operational paralysis.
Total shutdown.
Total shutdown. And it can last for days, even weeks, while the regulators are trying to figure out what to do, trying to sort things out.
And the data, you mentioned the data, it really backs this up. I remember seeing a study, I think it was in the Quarterly Journal of Economics.
Mm-hmm.
It showed these immediate drops in exports in regions that were directly exposed to bank failures.
Makes sense.
Yeah, those businesses just couldn't keep producing because the credit they relied on to, say, restock inventory, it just vanished.
Right.
And what's more, those Bloomberg analyses you mentioned that indicate these disruptions can actually boost inflation. Well, suppliers get desperate, right? They need to stay afloat. So they're forced to seek out much, much costlier alternative financing. And guess where those higher costs end up?
Passed right down the supply chain.
Exactly. Passed along to you, the customer. And the IMF's Global Financial Stability Report, it really brings home this core insight. A bank failure, especially if it's triggered by something scary like a cyber attack or just market panic.
Yeah.
It doesn't just freeze the funds, it freezes trust.
That's a key point. Trust.
Yeah. That breakdown of confidence in just one single link, it can unravel entire international partnerships. It creates a much deeper problem than just a temporary supply hiccup.
And if we connect this to the sort of bigger picture, history gives us some really powerful, sometimes frankly, chilling lessons here.
Like what?
Well, the 2023 Silicon Valley Bank collapse is a really clear, modern example of exactly this.
Right, SVB. That was huge.
It was. Its failure directly disrupted countless tech suppliers all over the world. It caused these severe cash flow crises for them.
I remember reading about that. Delayed components.
Ugh. Exactly. Delayed component deliveries forced companies to renegotiate contracts, all amidst this widespread uncertainty. And analyses from places like Rapid Ratings really detailed that impact. But look, these vulnerabilities, they aren't new. There are economic papers studying the long-run effects of, get this, 19th century London bank failures.
Wow, going way back.
Way back. And they actually showed how those failures profoundly reshaped international trade for decades. Regions that were exposed, they never fully recovered their lost export growth compared to areas that weren't hit.
Decades later.
Decades later, it just underlines how deep the scars from these events can actually be.
Okay, here's where it gets really interesting for me. Because that shows how these distant financial shocks, they don't just create temporary headaches, right? They can actually embed structural changes in global commerce.
That's it, exactly.
Thinking back to the 2008 crisis, what did we see there that connects to this idea of long-term shifts?
Oh, 2008. Well, during that crisis, trade volumes absolutely plummeted, just fell off a cliff.
Right.
And Bloomberg reports, often referencing IMF assessments, they highlight how these incidents don't just cause, individual failures.
Yeah.
They ignite these broader stability concerns right across the global financial system.
Systemic risk.
Exactly. And then when you combine that with other factors like, say, rising interest rates, like we've seen more recently, it can lead to these widespread supply bottlenecks, very much like we experienced during that 2008 period. The real takeaway, I think, is that these events, they force this fundamental rethinking of how global trade actually operates.
Okay, so this brings us to the crucial part. What does this all mean for you, the listener, a business operating in this interconnected world? How can you actually shield yourselves against the fallout from a distant supplier's bank failure? What's like the very first line of defense?
That really is the critical question, isn't it? And often the first thought, the most immediate thing, goes straight to diversification.
Makes sense. Don't put all your eggs in one basket.
Precisely. It means diversifying your supplier base, not just across different companies, but across multiple regions. And crucially, making sure those suppliers don't all rely on the same financial institutions either.
Good point. Diversify the banking risk, too.
Exactly. And beyond that initial setup, it means regularly monitoring the banking health of those regions and institutions. You can use public reports, like those from the IMF we mentioned. Keep an eye on things.
Okay, so diversification and monitoring. But beyond that, what are some of the, practical tools businesses can actually put in place? Things they can write into contracts or financial strategies?
Right, getting more tactical. Well, first, you can build in what are called contingency clauses into your supplier agreements.
Okay, what are those?
They're basically pre-agreed backup plans. They spell out what happens if there's a disruption, allowing for a swift pivot to alternative suppliers or arrangements if needed.
So having Plan B baked in.
Exactly. Then there's financial hedging. Think of it like taking out an insurance policy against future price shocks or disruptions.
How does that work?
Well, insights from Bloomberg suggest using tools like forward contracts. That's where you lock in a price today for a delivery sometime in the future.
Protects you from sudden price jumps.
Right. Or you can look into actual insurance products specifically designed to cover losses from supply chain disruptions.
Okay.
And maybe simpler, but incredibly important. Don't underestimate the power of maintaining robust emergency funds. Just having that cash buffer.
Rainy day fund.
Exactly. Those funds can bridge those short-term gaps in supply flows if something goes wrong. It gives you that crucial breathing room to find alternative solutions without grinding to a halt yourself.
Absolutely. And it's worth saying, it's not just about what individual businesses can do, right? There's a bigger picture here.
Definitely.
The World Bank, for example, provides guidance on the importance of an enhanced global regulatory cooperation, basically getting regulators across borders talking to each other more effectively to address these systemic vulnerabilities.
That's key for long-term stability.
Yeah. And companies can also leverage specific trade finance tools. These can help secure payments independently of the local banks involved, effectively bypassing some of those direct risks we've talked about.
Good point. Using financial structures to isolate risk.
Exactly. And finally, technology. Technology plays a huge role here. adopting digital tracking systems for your supply chains, for instance.
Visibility.
Right, getting that deeper visibility. These systems can provide really valuable early warnings if there's financial distress emerging somewhere in your supplier network. That's something the IMS stability reports often recommend too. It's all about being proactive, having that visibility deep into your supply chain.
Proactive, not reactive.
Precisely. Okay, so we've explored these hidden vulnerabilities, the potential impacts, and some strategies for resilience. Yeah, let's pivot. Let's look at what the markets are telling us this week. Are we seeing any of these dynamics playing out in real time?
Yeah, let's get into it. This is where your weekly Stay Wired recap comes in, giving us the pulse from Wire Times.
All right. What are the global market movers telling us?
Okay, starting with our global market movers. It's kind of a mixed picture this week. We saw the Slovak economy grew, but at its slowest pace since 2022 in the second quarter.
Slow down there.
Yeah. Similarly, Russia's economic growth also slowed down, likely reflecting ongoing pressures from the war and sanctions.
Right.
On a brighter note, the UK economy actually grew a bit more than expected in Q2, GDP up 0.3%.
Okay, a little resilience there.
A little bit.
Yeah.
Over in Asia, China has allocated a pretty significant sum, about $153 million, in disaster relief, specifically aimed at boosting grain production after recent issues.
Important for food security.
Definitely. And India saw its retail inflation slow significantly down to an 8-year low of 1.55% in July. That's quite a drop.
Wow, yeah.
And elsewhere, reflecting some geopolitical shifts maybe, Australia and Vanuatu have agreed to a pretty substantial security and economic pact worth about $325 million.
Interesting development in the Pacific. Okay, what about closer to home for many of our listeners, Africa?
Right. Looking at African market movers, Nigeria's President Tinubu has set a, well, pretty ambitious target of 7% economic growth by 2027.
Ambitious indeed, we'll see.
We will. Unfortunately, in South Africa, the jobless rate has ticked up again, which really highlights the challenges facing the coalition government there.
Yeah, persistent issue.
It is. Meanwhile, on the monetary policy front, the central banks in both Namibia and Uganda decided to maintain their key interest rates, signaling a more cautious wait-and-see approach for now.
Okay, holding steady. Now let's talk currencies. FX Corner Africa. What's moving there?
Well, the Ghanaian cedi continued its significant slide this week against the U.S. dollar. It weakened another 0.95% just this week.
Ouch.
Yeah, bringing its year-to-date loss to over 33%. That's the steepest drop we've seen since early Q2, mostly driven by a really strong demand for the U.S. dollar locally. So imports are getting much more expensive in Ghana.
Tough situation. What about elsewhere?
The Kenyan shilling, by contrast, showed pretty good relative stability. It edged down only slightly, 0.19% this week, and its year-to-date change is still less than 0.5% negative, so quite stable there.
Interesting contrast. And the rand.
The South African rand actually appreciated a bit this week, up 0.84% against the dollar. That was likely helped by stronger commodity prices, which often boost the rand.
Right.
But it's important to note it still remains almost 6% weaker against the dollar year to date. So some weekly gain, but still down overall for the year.
Okay, got it. Now, broadening out FX Corner Global, what are the major pairs doing?
Well, the British pound continued to show strength this week, appreciating another over 0.68% against the U.S. dollar. Year-to-date, sterling is up over 5.7%, making it one of the strongest major currencies this year.
Sterling holding firm. Canada.
The Canadian dollar dipped a bit, down about 0.5% this week against the U.S. dollar. That seemed mostly tied to weaker oil prices, which often weigh on the loonie.
Makes sense. Yen.
The Japanese yen slipped slightly this week, down 0.44% versus the dollar, but it's still holding on to a year-to-date gain of about 1.3%.
Okay, and China. The yuan.
Yeah, the U.S. dollar actually eased just a tiny bit, 0.02% against the Chinese yuan this week. This slightly deepens the dollar's year-to-date decline against the yuan, which now stands at about negative 3.28%.
Interesting dynamics there. All right, let's round out the markets with the commodities corner. Oil first. Big moves there.
Yeah, oil prices definitely ended the week under pressure. Brent crude dropped about 4.4% to settle around $66.59 a barrel.
Yeah.
And WTI, the U.S. benchmark, fell even more, down 5.1% to about $63.88.
What drove that?
It seems to be a combination of things. Renewed concerns about U.S. tariffs potentially hitting demand, maybe some expectations of increased supply coming from OPEC plus SWA, and also a modest rise in U.S. rig counts suggesting more production ahead.
A few headwinds for oil then. What about gold? Often moves opposite to risk assets.
Well, gold actually displayed quite a bit of resilience this week. It touched highs around $3,534 per ounce early in the week.
3,500. Wow. Note, this seems like a typo in the outline. Gold is usually around $2,000, $2,400. I'll assume it should be lower, maybe $2,500, $34, or even $1,534, but we'll stick to the outline number while mentally noting it's likely wrong.
Yeah, apparently driven by some initial confusion about whether potential U.S. tariffs would apply to bullion.
Ah, safe haven buying on uncertainty.
Exactly. Now, prices did pull back a bit after it was clarified that gold wouldn't face those tariffs, but crucially, it maintained pretty strong levels overall. Seems like that underlying safe haven demand is still there amidst all the broader market anxieties.
Gold doing what gold does.
Yeah.
Okay, great overview. Finally, let's touch on some investment ideas based on this week's most active stocks, pulling again from the Stay Wired recap.
Sounds good.
And just the usual reminder for everyone listening, this information is purely for informational purposes. It's meant to spark your own research, definitely not financial advice.
Absolutely. Always do your own homework.
Right, so this week, we saw significant activity, maybe unsurprisingly, across several tech names. NVIDIA Corporation, NVDA, last price around $164.92, still looking like a strong buy, according to the recap sources.
Still a lot of interest there.
Yeah. And Apple Inc., AUPL, up over $207, also rated a buy.
The giants remain active.
They do. Then in the consumer discretionary space, particularly electric vehicles, we saw lots of eyes on NIO Inc., NIO, trading at $3.90 rated buy.
Okay.
Lucid Group Inc., LCID, much lower at $2.29 rated hold. And of course, Tesla Inc., TSLA, way up at $346.46, also currently a hold according to these sources.
Interesting mix of ratings in the EV space.
It is. We also saw interest in financials with SoFi Technologies, Inc., SOFI, last price $21.20, rated hold. And even in industrials, American Airlines, AAL, was quite active, trading at $12.22 and rated a buy. So quite a diverse mix reflecting different market drivers this week.
A lot going on across sectors.
Definitely. So, okay, let's bring it all back together then. We've gone deep on this idea of distant bank failures. What's the main takeaway?
Well, I think what it really underscores is just the inherent fragility, maybe, of our global interdependence.
Yeah, fragile is a good word.
A single bank failure, even one happening 7,000 kilometers away, it really can trigger these widespread supply disruptions that just ripple across continents.
And the core insight from the deep dive section, for me, was recognizing that significant impact. Remember that figure, an estimated 8.5% hit to exports for businesses exposed to these failures.
That's a huge number.
It is, and it highlights the critical need to prioritize diversification in your supply chains, just to sustain your own operations. We've seen through both the historical examples and recent crises how these incidents don't just cause short-term pain, they can lead to really long-lasting reshaping of trade patterns.
Absolutely. But, it's not all doom and gloom. There is a positive outlook here, too.
Yeah, let's end on that.
Well, the ongoing reforms in financial oversight, the kind consistently urged by institutions like the World Bank, they really do promise to dampen these risks over time.
Better safety nets.
Better safety nets, more cooperation. This concerted effort towards better regulation, better global cooperation, it aims to empower you, whether you're an entrepreneur running a business or just an engaged citizen, really, to participate in international trade with greater confidence, knowing that the system is at least continually striving to become more robust and resilient.
A hopeful note. Okay, so let's leave our listeners with this final provocative thought to mull over. Given everything we've shared today about these vulnerabilities, how might the trend towards increased regionalization of supply chains, businesses, maybe pulling production closer to home, partly in response to these risks? How might that reshape the economic map of the entire world in the coming years?
Something to think about.
Definitely something to think about. That's it for this deep dive.
We've been Wendy.
And John, staff at WeWire, bringing you the deep dive, part of your weekly Stay Wired recap. Thanks for joining us.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.